It's now my pleasure to hand over the stage to Nick Gradell, who will kick off things with a presentation on investment flows and share ID, followed by a quick discussion and a Q&A.
Great. Thanks, Michael. Good afternoon, everyone. My name is Nick Gradell. I'm a partner at Investor Update. We're a shareholder analytics and advisory company based in London. Work all across Europe. I've got quite a few clients in Switzerland. It's a good market for us. I've been with them for 6 years. Before that, I spent 20 years in banking, equity research, and equity capital markets. So it's a pleasure to be here. The Trump effect on fund flows. We, like most people, were fascinated back in November when the election came around. Fascinated by the results, concerned, optimistic, pessimistic, all series of emotions the day after. But we kind of thought, well, what does it mean for our clients? What does it mean for US investors? How will they behave? And I think what's interesting is the headlines. At the beginning, everyone thought this is going to be great for US equities, right? He's going to have a America First campaign strategy. And, pick day here, I've picked two things at random. Pick day talking about the positive news for US equities. The second FT article is the Bank of America survey that was done shortly after the US election. Sentiment is really weak in Europe and really, really strong in the US right now, said the US equity strategist at Citi. So everyone thought, okay, what does that mean for Europe? Are we going to be sidelined or not? And certainly at the beginning, the US markets outperformed Europe. So in this chart, the S&P is blue and green is the Nasdaq. The dark red is the SMI and the yellow is the Stoxx 50. And you can see that initially, the US markets were outperforming, but then when it comes to sort of January or February, when the story changed to tariffs and Trump actually doing what he said he would do, certainly the US markets took fright and Europe started to wake up a little bit in terms of market sentiment, in terms of defense spending, in terms of various sort of topics. And certainly with Liberation Day on April the 2nd, you saw a huge downturn in all markets, but certainly that outperformance of Europe in February, March and April was very, very, very marked. And there was that expectation of, is this time for an asset rotation away from the US into equity markets in Europe, into private equity markets in China and Asia. And so that rotation was a relief because, to be fair, the US equity markets had dominated over the performance over the last 5 years. What we then saw towards the end of April into May was a recovery in the US as Trump backed away from some of those policies. Gave pauses on some of the tariffs, delayed things, reduced the tariffs for China to give time to negotiate. So the US has caught up, but there's a definite clear outperformance of Europe over the US since the election, and especially since January when the tariff noise started. We do share IDs, right? So we do IDs for over 100 clients in Europe. What did we see? We saw, and I went through all the IDs that we did from December, January, February, March, and April. About 3/4 of our IDs saw an increase in US ownership. So the anecdotal evidence was definitely there. And in terms of number of US institutional investors on the ID, it was over 80% saw an increase. So we did see these flows coming through in the analysis that we were doing, but there was also a bias towards large caps, probably because of passive flows. But one of our largest European clients saw US ownership go from 40% to 60% of the shareholder register, which is pretty dramatic. And then you've got lots of data, and I'm sure you've seen lots of the headlines. These are fund flows from Vanguard, and you can see on the left-hand side is April. Biggest inflows, Europe, Euro area, global, Germany. Biggest outflows, US. As I said, in May, The US starting to come back as the sort of tariff noise subsided a little bit. But again, global, Europe, and Euro area in the top 5. So there was clear asset reallocation towards Europe. But what was really going on? What was going on behind this? You had lots of people talking about what sectors were going to succeed, what sectors were going to fail. On the left-hand side, this is from a European advisory company. They predicted energy, aerospace and defense, pharma and biotech would be the top 3 performers. Luxury and apparel, financial services at the bottom. We'll come on to some of the sector performance, but I think that is pretty much not right. And I mentioned the Bank of America survey at the beginning. This was now from last week, and the bottom right, Bank of America's were most underweight in the US dollar for 20 years, while net balance of 35% were underweight US stocks. These are the same people that 6 months ago said this is the best thing ever for US equities. So there's been a complete shift in sentiment away from the US as the preeminent equity market to something more balanced. We're not saying the US market isn't going to perform, but it's more balanced. And so we thought, well, do the numbers back up what's been going on in the press? So we looked at public filings data. What were US funds doing in European and Swiss equities? What was the impact by sector? Was it driven by active or passive? So we looked at public filings data from October 31st to May 31st in the Stocks 50 and what I'm going to call the SMI 50, but we enlarged the SMI to get more companies in it to have a broader spread of sectors. We look at it by regions, so US investors, Switzerland, UK, Europe, rest of world, by sectors, and by active versus passive. The one thing to say here is this is using filings data, so it's incomplete, right? Filings data can be anywhere from 40 to 60% of a register, let's say. So it's heavily institutional biased. No retail, limited sovereign wealth, well, Norges is always in there. Little family office or wealth, but some is in there. And the filing dates are varied, right? Some people filed April 30th, some people filed March 31st, some people February. So it's not an exact science, but I think that the trends that the data spits out are pretty meaningful. So, general observations. Left-hand side, the respective market caps, the stocks was about 3 times, 2.5 times what we looked at in Switzerland. The sector splits, I'm going to see if this laser works. Here we go, there we go, doesn't really help. The sector splits, the stocks very much focused on consumer goods, TMT, financial services, industrials. The 2 little bars at the end are energy and real estate, so pretty small. In terms of the SMI, it's clearly driven by consumer goods, financials, and healthcare is the biggest chunk there. In terms of sector performance in those 7 months, from end of October to end of May, financial services in Europe up 20%, utilities up 20%, energy, which one advisory firm said would be the big winner in equity markets, was down over 10%. And in terms of the SMI 50, as we call it, financial services and consumer goods outperforming, healthcare, pharma down, and real estate up very strongly, but that's two companies, so I won't focus on the real estate sector in too much detail. So the investor splits, in terms of what you can get in filings data. The US is pretty similar for Switzerland and Europe at around 40% or so. Europe and the UK, together with the US for the Euros, for the Stocks 50, is well over 90%. So those 3 markets do dominate. Clearly in Switzerland, domestic investors are a very, very key part of the puzzle. Active passive splits, A lot more passive money in Switzerland, again, from the declared positions. So close to 50% passive in our SMI index. And then on the right-hand side, it shows you the splits by active and passive for Europe and Switzerland. So in Europe, just so that you follow this, the biggest influence on European equities is active European money, followed by active US money and passive US money and active US money. In Switzerland, US passive is the biggest part of the piece, followed by US active, Europe active, and then Swiss money active and passive, as per the bottom right. So what did we see? This shows the percentage increase in fund flows, net performance, for the stocks and the SMI by region and investor type. So there's a lot of red on this chart. So passive has been driving fund flows in Europe. Clearly in every region, passive is outperforming active. So, and quite markedly. So in the stocks, it's over 10% passive flows, 3% active. In SMI, it's 8% passive and 3 to 4% active. What's quite surprising on the European side is how, I'm not going to use the word passive, how uninterested UK active money is in Europe, right? Again, UK money does seem to be struggling to find its home at the moment, and there have been some redemptions at certain larger institutions. But this is a pretty clear picture. However, this is a percentage basis. If you look at it by dollar basis, what is the dollar impact? So the amount of dollars from each of these different investor brackets, US passive is driving both markets, which dovetails with what Vanguard has been seeing with the ETFs and index funds. Euro active, Euro passive, and UK passive driving in either in Europe. Again, passive driving on the Swiss side, but in terms of active markets, it's much more balanced between the US, Europe, UK, and Switzerland. In terms of fund flows by sector, the blue is US flows, the yellow is global. So US flows have been strongest in consumer goods in Europe and financial services. Again, financial services being the strongest outperformer from a stock market returns perspective. Healthcare and materials also strong. In Switzerland, it's a little bit more balanced between the two, but certainly TMT, I know it's a smaller sector in Switzerland, has seen much more US money than global money, and materials has been an underperformer in that respect. This splits up active US money versus passive US money across these sectors over this 7-month period. So the red is passive, the green is active, and the US is the overall flows. So I'll take a little bit of time to try and explain this, but clearly where the green is higher means there's more active involvement in that sector. So financial services has seen much more in active money than passive money, and so that's where active fund managers in Europe, in the US, have been looking at European stocks. Likewise, to some extent, healthcare, pharma, likewise real estate, but it's only one company. In terms of where active US money has been less deployed, it's energy, utilities, industrials, TMT, and consumer goods. In terms of Switzerland, it's a bit of the inverse. right? Whereas financial services was a focus for US active money. In Europe, it clearly isn't. In Switzerland, materials, chemicals, again, is not a focus. Industrials is not a focus. You know, in terms of tariff expectations, you know, those are two sectors clearly that will suffer, that may bear the brunt of tariffs, and so that they have been avoided. And in terms of consumer goods, conversely to Europe, it has been more of a focus for US active money. So the differences are clear. I think consumer, there's much more active US money focused on Swiss consumer versus European consumer, and that may be because there's more discretionary in the European stocks. US active money much more focused on European financial institutions than Swiss, and in both cases, US active money less interested and less deployed in industrials and materials or chemicals. I have got several worksheets of Excel with which investors have been buying and selling in both Europe and Switzerland. Here are some of them. The ones on the left are buyers in Europe: Fidelity, TII, CREF, Capital, Goldman, Thornburg, in significant amounts. Fidelity and FMR has been buying everything in Europe and Switzerland, basically. They're near the top of the charts in terms of active fund flows. Likewise, Capital. So there are very strong institutions that have made bets in Europe over the last 6 months. Conversely, Invesco is selling in Switzerland, is selling in Europe. MFS is selling in Switzerland, is selling in Europe. MFS London is selling in Europe and selling in Switzerland. So there are definite bets and decisions that have been made across these markets from the bigger institutions. T. Rowe Price has been selling Europe, buying Switzerland. So again, there's a lot of helpful information in terms of who you should be seeing, who is betting on Europe, and I'm happy to run through a lot of those names afterwards or on a call. There's a huge amount of detail just to give you an indication of some of the US funds that are buying in Switzerland: Capital, FMR, BlackRock, Active, TI, CREF, First Eagle, Goldman, T. Rowe, Thornburg, Franklin, Jennison. Selling Dodge & Cox, Wellington, PrimeCap, Lazard, Invesco. So it's there are definite, and some of these numbers are huge. FMR and Capital in particular are massive. In terms of the rest of the world, let's start with Europe. Germany seems to be definitely deploying more capital. So DWS and Deka have been buying a lot of Europe. DWS has been buying a lot of Switzerland. In terms of Nordics as well, Swedbank Robur have been very active, and funds allocated to both geographies have gone up significantly. Likewise, Nordea. In terms of rest of the world, maybe it shouldn't be a surprise. Canada has been buying a lot of European and Swiss equities. They're probably selling US because they don't like the US at the minute. They're not buying their strawberries. So they're not buying their equities either. So whether it's a CPP, TD, Asset Management, Fidelity Canada, Burgundy 1832, CI, CIBC, there's a lot of Canadian buying. And certainly, you know, when you do your next roadshow, do not forget Toronto. So that's that for the moment in terms of those fund flows. Definite. Well, this will be circulated afterwards, so you can see what the constituents were on this, so that you can to check that we've done our numbers right. So I'll take a quick pause there and have a drink of water. I want to spend a little bit of time. I've got a lot of slides here. I'm not going to go through all of them. Don't worry. I want to spend a little bit of time though on the whole concept of share IDs. I don't know if we can do a survey in the room. Hands up, who does shareholder IDs as part of their IR program? 1, 2, maybe. All that sort of information on fund flows becomes really relevant when you know which of those are your shareholders, which aren't, which of those have been buying, which have been selling, which of those you can engage with, which of those you can prioritize for management time, which of those you need to go and see because they've been selling their position, or phone them up and say, you know, what's going on? Is it a sector rotation, or are you selling us for a certain reason? And so for us, and I would say this because it's the core of our business, one of the fundamental building blocks of investor relations is understanding your shareholder base. So I just wanted to talk a little bit about an ID, why to do it and how to do it. And then Michael, you can tell me when I've run out of time. Logic for shareholder ID, right? If you have the detail of your shareholder base, what does that tell you? It allows you to identify new entrants for engagement, right? Who's been buying in the last 3 months, 6 months, 12 months since we last did an ID. You can prioritize investors for management. Who does the CEO and CFO need to see? It allows you to target, because you know who's an investor, you know who's not an investor. And that allows you to look at your peers and say, okay, here are underweight or absent investors versus our peer group. Proxy and corporate governance. If you know how many shares people hold, you can count the votes, you can chase for the votes, and you can reconcile the votes. But more importantly, you can then understand the corporate governance policies and voting history and voting policies and potential activism of your shareholders. Do they follow ISS? Do they follow Glass Lewis? Do they make their own mind up? And so, again, understanding your shareholder base will allow you to understand what is going to drive voting behavior at your AGM, which I'm sure will be talked about later. Identify and track activists. We've done that for Airbus, we've done that for Delivery Hero last year, of looking at, and Delivery Hero is an example where we said, oh, there's a bit of noise. Who's dialed into your last earnings call? Oh, it's just a bunch of hedge funds and long onlys as ever. So he said, send us the list. So we looked through the list and we were like, activist, activist, potential activist, activist. And suddenly, but we've spoken to them, they were really, really nice and interested. And of course they're going to be really nice and interested. They want to find out as much about you as possible. So they are going to be nice. And so having that understanding of which shareholders, of the shareholder behaviors and potential activism, means you can identify those, and if necessary, you can track those on a weekly, monthly basis to see, are they building their positions? And is there something to worry about? Likewise, and a lot of shareholder IDs will not have much detail on hedge funds, but we I'll come on to that. We have a lot, but also bank positions, understanding desk positions at a Morgan Stanley, at a UBS, at a Goldman, is important to understand in aggregate. If those bank positions are increasing over time, what does that mean? Does that mean there's someone sitting behind those positions, building positions at different banks, in order to at some point declare a position of 2.99% and go over it, in order to go under the radar and catch you unawares? So that's another thing that we track. And proactively managing your selling shareholders. If you have an accurate understanding of that shareholder base, you can do all of these things. If you don't, or have inaccurate data, it's a lot more difficult to do these things. And so we believe very strongly that understanding the ins and outs, the institutional level, the fund level data and detail is very, very important for you to engage and build the relationships with your shareholders. How do you do it? Share register is the starting point, full of holes. Voting and dividend lists, very helpful. Public filings data, full of holes, or specialist share ID provider. Just to go through some of these points very, very briefly. Swiss registers are helpful for Swiss institutional ownership and Swiss retail, but it doesn't really help you for your international ownership. So we've got 3 examples here. Orange is the percentage is bearer shares, blue is registered. So in the first two examples, it's 50-50. In the third, it's, let's say, 70-30 registered to bearer. Analysis of those registers gives the second pie chart, which in the first two cases is 50% of your shareholder base is unidentified, because it won't come up in the register. It may come up as a custodian, it may come up as a nominee. On the third case, it's just over 25%. So you are flying blind based on the register for international investors. And then our IDs at the bottom, the unidentified is anywhere from 0.5% to in the last case, about 5%. Because we will go to those custodians and ask them those positions, whereas the register might say Chase, New York, it might say JP Morgan, it might say Bank of New York. But you've got to go into the next level and the next layers to identify which investors sit behind each of those positions. Filings data, a lot of information in this chart, just focused on the difference between grey and blue. Top half, the number of institutions identified on public filings data versus our share ID. So the Swiss example in the middle, a mid-cap client of ours, filings was 213 institutions, we had 417 on the ID. The bottom half of the chart is the percentage of issued share capital or free float identified through filings and through our IDs. Filings on free float at best 50%, maybe 60. You know, we're 90% plus, usually in the high 90s. So there is a big difference in what you can garner from register plus filings. The other thing with filings, and that's why everything with filings you need to take it with a pinch of salt. It can be from last week, it could be from last year. Here are examples, and again, this will be sent around so you can look at it in more detail. But positions change dramatically on filings. The middle one is hedge funds, where it's gone from 10 hedge funds on filings to 37 on an ID. Broker positions from 0 to greater than 15. So something is going on there. And on the right-hand side, hedge funds as a percentage of free float have gone from 1.2% to 6%. Anything more than 3% of hedge funds on your shareholder base is something to think about. In terms of what we do, we use your register, we use public data, and then we go to all custodians in terms of asking on your behalf as a legal requirement to disclose their positions to us as your agent. So we'll get 50, 60 custodians sending us back details, but we'll also direct most major investors, all hedge funds, anyone that you've met with or spoken to in the last 12 months. And that means we get sort of like double entry bookkeeping. We have the custodial number, we have the direct disclosure from the investor, and that's how we build up the ID from the bottom up to make sure that we get the numbers right. And what we always say is we prefer to be, it's all about accuracy. We prefer to be 100% accurate on 90% disclosure than 90% confident on 100% disclosure. Because it's that meeting when the CEO goes in and doesn't understand that this investor has been buying in size, or the number is wrong, or where a hedge fund phones you up and says, I've got 2% of your stock, I'd like to meet the CEO. In fact, we do the analysis and it's 0.8% or 1%, right? But they will they will try and get access. And so having that accuracy is paramount. I'm not going to talk about this because it's way too much detail, but you can see it. Every ID we've done, we've increased the disclosure from the previous provider. In some cases, it's very small, from 96.1% to 98%, but it goes up. But it's the depth of analysis. We're about to take on one of the largest Swiss companies. We've just been sent their previous ID. They only have fund level data for the top 50 institutions. and they've got several hundred institutions on their in their shareholder base. That's no good, right? Top 50, fine, but you need to know which funds are holding rather at which institution, which funds have been buying at which institution, not just the institutional level. Number of institutions identified for our large caps, up 18% on previous IDs from previous providers. We had a Swiss issuer. The number of Swiss institutions jumped from 45 to 102 within 6 months with our ID. There weren't over 50 new Swiss buyers. It was the fact that previous providers didn't get the disclosure. And so again, these are things that I think are very, very important. If you're going to do it properly. The number of US investors identified on average go up 35%. Again, super relevant right now given the discussion we've had, given the added impact of US flows into Europe. This is way too much detail. I don't want to bore you anymore. I've got some shameless marketing at the back, but I don't think. Again, you can look at this. You can ask me afterwards in terms of how we do things, why to do it, how to do it, certain situations that we've worked in. But I'll stop there for the moment.
Great. Thank you, Nick, for your input on this. We have just a couple of questions, follow-up questions on your first input on the U.S. investors and investments. You will have time to ask a couple of questions if you want to afterwards. Nick, so U.S. investors, we've seen, represent a significant portion of the European shareholder base. In your view, what are the most effective strategies for Swiss companies to engage with U.S. investors? Should they prioritize broker relationships, direct outreach, or a combination of both?
We would recommend a combination, right? Your brokers will have access to lots of investors, but with a caveat. And I've spent 20 years in banking, and I've seen this. You ask a client asks a broker to organize a roadshow, and you're like, absolutely, we'll do this. And then, a day in Paris, we've got the CFO in Paris for a day. The first 3 meetings, great, top shareholders, very easy to organize. Meeting number 4, not so sure. Meeting number 5, you walk in that meeting, and within 30 seconds, you know that it's a filler meeting, friends and family. But the guy asks the question of, so what do you do again? Brokers will put you in front of their clients who give the most in terms of commissions. And so you will end up often seeing the same people in every location with certain brokers. But it's very important because they do have that access. However, if you do a proper targeting, you can see that, let's say you do 2 days in New York, you can see those 20 funds and institutions that invest in your peers, but not invest in you, or are underweight you versus the peers. So those are relevant investors. So what you do, you say, right, first day in New York, we'll see all your friends and family, that's fine. Second day in New York, here's a list of 20 institutions that we know are relevant because they invest in our closest peers. Please set up meetings for us. And if they don't, well, then you know that it's time to try a different broker or a different approach. Direct also really works because I think once you identify some of these, and again, it depends on the size of your IR team, of course. But once you identify some of these targets, stick them on your mailing list, and then make sure that if you are in New York or Boston or London or Stockholm, that you, 1, work the brokers, but 2, try and build the relationships up direct as well. So I think it's a blend of the two, but having that detail will hold, you can hold your brokers to account by saying, these are the people I want you to set meetings up for you, up with, right? These are the guys that will move the needle for us in this jurisdiction, in this city, in this country. And I think that's important, to be able to have that data and detail to be able to push your brokers.
Okay. And you also spoke about just passive investments before. So much of the recent inflow from European equities has come from passive in vehicles such as index funds and ETFs. What are the key implications of this for investor relations officers? And in particular concerning engagement and communication.
I mean, passive is great because it's pretty sticky. So once you're in an index, as long as something doesn't go horribly wrong, you normally stay there, and it's passive money. And if you get inflows, those inflows will continue to be invested in you. So passive is very helpful. Can you influence passive? You can to some extent. By, let's say, on the ESG side, you can influence the ratings, and which ratings are relevant for which ESG indices. So you can say, right, you can look at the ESG, passive ESG universe and say, MSCI is the most important component of those. If I get a certain level in a certain rating in MSCI with other factors, then perhaps I can increase the membership of ESG indices, which will lead to greater ESG, passive ESG investment. So you can influence it more on the ESG side than I think you can on the non-ESG side. I think the key is, yes, you're not necessarily going to engage with these investors terribly much because they're passive, but don't forget that the one time they can influence their position is at the AGM. And so passive investors will vote. They will take meetings to discuss how you're going to vote. And so you've got to have a strategy to engage with them to make sure that they're on side with what you're trying to do on remuneration, on issuance or other things. And so you don't have to go and see them, but you do have to think about them and work out how their voting may influence the outcome of your AGM. So it's very important to stay on top of them.
Fantastic. When it comes to share ID, there's considerable also variation in the quality and accuracy of shareholder identification reports, as you've seen across different providers. What are the main factors driving these discrepancies, and how can companies ensure they receive reliable data?
One is, very simply, if you're not sure in a position, ask them where they got it from. Was it a custodial disclosure, was it direct disclosure, or was it a piece of filings data that they've carried over for the last 6 quarters? There's examples in there where it was a Dutch client, they had 9 Swiss positions that appeared one quarter, and they moved completely in tandem for 9 quarters, 9 IDs, and then fell back to 0. So it was clearly a disclosure they picked up once and just carried across on the spreadsheet for every quarter. So if you don't believe a position, ask your provider, where did you get that position from? So that's the one thing, is hold them to account. The other thing is, you've got big data companies where the ID is secondary in terms of their priorities. They do it in a very sort of structured, inflexible way. So various times we've done individual institutional updates because we just have to send a disclosure request to Vanguard or BlackRock, and they'll send us the detail the next day. But some bigger companies are quite inflexible, and so they won't do that. They'll just do their run-of-the-mill IDs every 3 months, 6 months. And so you want to have that flexibility to update positions. You're suddenly going to see your biggest shareholder in 2 weeks' time, and you want to just double check what position they have, if it's changed at all. We do that very easily. We send out the disclosure request, comes back, and we say the position has gone up 5%, down 10%. So the CEO knows in that meeting exactly what's on the other side of the table. So some people use flawed processes. Some people are very inflexible in their approach. Some people don't ask the right custodians. Certain custodians work with a lot of hedge funds. If you don't ask them, you don't get the disclosure. It's pretty basic. Doing an ID isn't rocket science. It's about asking people the right question, and asking all the right people the right question, and then building up the ID. And unfortunately, lots of people don't do that.
Is there a right frequency to conduct these identifications?
I mean, if you don't do an ID, your first ID will give you guaranteed 6 months of information, right? Because you'll find out from 0 to 600, 500 who your investors are. You can then say, in terms of your peer group, who is missing. So you have straight away, you've got targets for at least a couple of quarters that you can go after. So smaller companies might do one a year. Larger companies might do quarterly, 6 times a year. In the UK, they do with their corporate brokers, they do monthly. But to be honest, monthly, they don't even look at it because it's so frequent. So I think 2 or 4 times a year if you're a decent sized company.
Okay. Maybe we could take some questions also from the audience now. Are there any questions? Anyone? I see there are no questions.
No questions.
I think we're otherwise than good, right?
Yeah.
Great. Thanks a lot, Nick,
Thanks.
for your input.